HMRC opens thousands of inheritance tax compliance checks every year. And the truth is, most of them don't start because someone was trying to cheat the system. They start because of things that were overlooked, undocumented, or simply misunderstood. In this video, I'm going to walk you through 5 red flags that can trigger an HMRC investigation into an estate. And more importantly, what you can do right now to make sure your family isn't left dealing with the fallout. Because here's the thing, by the time HMRC comes knocking, you won't be around to explain yourself. It'll be your executors, often your kids, sitting across from HMRC trying to account for decisions you made years ago. That's a weight you can spare them. So let's get into it. Red flag number 1. Gifts you made but never recorded. If you've given away money or assets in the last 7 years, those gifts may still count as part of your estate when it comes to inheritance tax. HMRC calls them potentially exempt transfers or PETs. The key word is potentially. They only become fully exempt once 7 years have passed from the date you made the gift. If you pass away before that 7 years are up, the gift gets pulled back into your estate for inheritance tax. There is some good news. If you survive beyond 3 years, the tax charge starts to reduce on a sliding scale. But here's the catch. That only helps if your executors can actually prove when the gift was made. And that's where most people come unstuck. When reviewing an estate, HMRC can ask for up to 7 years of bank statements. They can see the transfers going out, but a bank statement can't tell them it was a gift or who it was intended for or which exemption applies. Without that context, HMRC can challenge those transfers and treat the full amount as taxable, which is usually the exact outcome you were trying to avoid in the first place. The fix is straightforward. Keep a record. Every significant gift written down at the time, the date, the amount, who received it, and which exemption you're using, if any. And it's worth knowing that exemptions are available because several are genuinely useful. The annual £3,000 allowance, the £250 small gifts exemption, gifts made on marriage, and the normal expenditure out of income exemption. That last one is particularly powerful for anyone with regular surplus income, and yet it remains one of the most overlooked reliefs available. The problem isn't that the exemptions don't work, it's that people rely on them without ever writing anything down. Red flag number 2. Undervaluing the estate, especially property. This one catches families out more than almost anything else. When someone passes away, every significant asset in their estate has to be valued. The family home, any other properties, investment businesses, and that valuation has to be accurate. It's tempting to come in on the low side. A smaller figure means less tax, and it can feel like a reasonable call, but HMRC has access to the valuation office agency and they do their homework. They check property against what similar homes were actually selling for at the time of passing, right down to the same street. If your figure looks too low, they will challenge it. And if they can show the property was worth more, the estate owes the extra tax, plus the interest from the original payment deadline and potentially penalties on top of that. The same applies to business assets and jointly owned property. If you're reducing a valuation to reflect a partial share, that reduction needs to be properly justified, not just assumed. The straightforward answer is to get a professional valuation. Keep it on file and don't try to nudge the number down. It will always cost less than having HMRC dispute it later. Red flag number 3. Giving away your home but still living in it. This is probably the most common mistake we come across. The thinking makes sense on the surface. Sign the house over to your children now, and by the time you pass away, it's no longer part of your estate. Simple. Except HMRC is so ahead of this. There are rules specifically designed to catch it. They're called gifts with reservation of benefit. The idea is straightforward. If you give something away but continue to benefit from it, HMRC doesn't consider it a genuine gift. Live in the house rent-free after signing it over, and as far as HMRC is concerned, you still own it. It stays in your estate and gets taxed in full when you die. The only way around it is to pay your kids a full market rent to stay there, which then becomes taxable income. Most families, when they hear that, decide it's not actually worth it. There are legitimate ways to reduce the value of your estate. However, gifting the family home and carrying on living in it isn't one of them. People who try it often leave their families with a bigger tax bill than if they'd done nothing at all. Red flag number 4. Assets HMRC finds that you didn't declare. HMRC's ability to cross-check information has improved significantly. They now have access to data from UK banks, investment platforms, the land registry, and through international agreements, overseas financial institutions as well. When an estate comes in, they check it against what they already hold. And if something shows up in their records that doesn't appear in that inheritance tax return, an overseas account, an investment portfolio, a rental property, a life insurance policy not held in trust, or digital assets like cryptocurrency, they will notice. Cryptocurrency is worth highlighting specifically because people still underestimate it. It forms part of your estate. It has to be declared. And if HMRC's data suggests you held it, but the return doesn't mention it, you've just given them a reason to look very closely at everything else. Jointly owned assets are another area where people make assumptions. Many believe that assets held jointly simply pass to the surviving owner and don't need to be reported. In terms of who inherits them, that's actually true, but the deceased share of those assets still need to appear in the estate return, even where no tax ends up being due. The simplest protection against all of this is also the most overlooked. Make sure your executors knows exactly what you own. A clear, up-to-date list of all of your assets kept alongside your will costs nothing to put together and could save your family a great deal of difficulty later. Red flag number 5. Missing the inheritance tax deadline. This one looks like a paperwork issue. It isn't. Inheritance tax is due within 6 months of the end of the month in which someone passed away. The moment that deadline passes, interest starts running. No warning, no grace period, from the day after. There's also a full account of the estate called the IHT 400, which has to reach HMRC within 12 months. Miss that as well, and penalties are added on top of the interest already building up. HMRC does make allowances when assets take time to sell. Property is the obvious example. There are provisions to pay IHT in instalments on certain assets, and that can genuinely help. But those provisions don't kick in automatically. Go quiet, miss the deadlines, and the interest keeps climbing. The real danger is how quickly 6 months passes when you're an executor dealing with grief, probate, and everything else that comes with settling an estate. If you're an executor or likely to become one, here is the practical advice. Know the deadlines before you need them. Start pulling information together straight away. If property is involved, don't wait to apply for instalments, and if things are taking longer than expected, keep HMRC in the loop. Going quiet is what triggers penalties. The cost of getting proper help is almost always less than the cost of getting it wrong. So, 5 red flags: undocumented gifts, undervalued assets, gifts with reservation of benefit, undeclared assets, and missed deadlines. Not one of these requires any deliberate wrongdoing. HMRC does not need to suspect you of anything. A gap in the records, a valuation that doesn't hold up, an asset that appears in their data but not in the return, any of those is enough to trigger an investigation that your family then has to deal with at the worst possible time. Every single one of these is avoidable, and that's the point. And the right planning is how you avoid them. If you'd like a clearer picture of where your estate stands and what you can do to protect it, click the link in the description to book a free, no obligation consultation with one of our estate planning specialists. And if you've enjoyed this video, please like, subscribe and share it with someone who actually might benefit. Remember, a little planning today can make a big difference tomorrow. So until the next time then, stay safe, stay informed and stay tuned.